Hello, I'm Dean Garrett. I'm a Smith Manoeuvre certified professional, and I'm excited today to have Robinson Smith here. For those who don't know Robinson, he has a double major in economics and Chinese studies and an MBA in international business. He's a former investment banker and retail investment advisor. He's currently the president of Smith Consulting Group Limited and the best-selling author of Master Your Mortgage for Financial Freedom, and currently the developer of the Smith Manoeuvre Certified Professional Accreditation Program. Welcome, Robinson. Thank you for making yourself available today.
Absolutely, my pleasure, Dean. Happy to do it.
So, what is the Smith Maneuver in a nutshell?
Yeah, basically this is a financial strategy which helps homeowners accomplish a number of beneficial things simultaneously. The homeowner who implements the strategy is going to see a reduction in their tax bill. They're going to speed up the elimination of their expensive mortgage, and they're going to build an investment portfolio that otherwise wouldn't exist. These are all very, very valuable things to Canadian homeowners, especially these days. And possibly one of the best things about it is it requires no additional cash flow from the homeowner on a monthly basis. So these benefits of taxation reduction, speeding up the mortgage elimination, building up this investment portfolio, all of these benefits start now and they increase exponentially over time. The fundamental premise behind it is if we've got the appropriate financing on our house, and this is where you as a Smith Manoeuvre certified professional would come in, Dean, then the Canadian homeowner is able to access the equity as fast as they're creating it. And what a lot of Canadians do when they have this type of financing is they'll pull out the equity and they'll consume it. They'll buy cars or motorbikes or boats, trailers, they'll go on vacation, etc. The important thing to do here, if you want to really increase your family's financial security over time, is when you have access to this new equity, you pull it out and you invest it. Okay, you invest it for long-term growth. You create wealth rather than destroy wealth. And because we're using these funds to invest on a monthly basis, we're doing this. Because we're using these funds to invest with a reasonable expectation of generating interest, we can deduct with reasonable expectation of generating income. We can deduct the interest that we pay over time. So it's very, very inexpensive debt. And this tax relief enables us to prepay this mortgage at least once a year. It's base case scenario. And if we're prepaying our mortgage, we're getting rid of it faster. And importantly, we're investing each and every month now instead of later, meaning we're able to take advantage of compound growth.
Time and compounding, two most magical words in a retirement investment plan, right?
Absolutely.
Without the time is the biggest factor. People, with the price of houses and the maintenance of the payments on a mortgage these days, who can afford the extra money, cash flow per month to plan for something that's 30 years off? You're in the now. You have needs today. So the program focuses on your current mortgage payment and your current cash flow.
Yeah, that's right. All you're doing is using the mortgage payment that you're making anyways.
Right.
So let's use
That's
it
key.
once.
I think a lot of people don't understand that when you bring up the topic.
Yeah.
So what is the origin of the Smith Maneuver?
Yeah, it was developed by my father, Fraser, back in the mid 80s. He was a financial planner in Vancouver at the time. And he wanted something special for Canadians. He saw the difficulties that Canadians faced, and in his research, while he was really learning how to become a great financial planner, he came across the fact that the Americans could deduct a good portion of their mortgage interest, and we Canadians could not. And of course, he didn't think that was very fair. So he set about to read the Tax Act. Fascinating read. And he dove into taxes. He dove into mortgages. He dove into all these different aspects, investing, and he came up with this strategy. He put his private clients into the strategy for about 15 years before he retired to write his book, which came out in 2002. And this is his book, Is Your Mortgage Tax Deductible? He didn't really like retirement after he wrote and published the book, so he came back into advising in 2005, and I joined him in 2006. So we were both investment advisors here in Victoria. He passed away in 2011, but I kept advising until the end of 2018 when I sold my business so that I could focus on getting word out to Canadian homeowners about this strategy, because it's so very important that Canadian homeowners understand that there is a strategy that can accomplish all this. So I'm doing that. And I also want to start training financial professionals, such as yourself, Dean, in the strategy, because we've heard so many times over the years of other people, other professionals, saying that they're going to put their client into the Smith Maneuver, but it wasn't the Smith. It was either a little bit wrong or a lot wrong. And so there's just a tremendous amount of misunderstanding out there. So it's so important that Canadians who are interested in implementing the strategy come to someone like yourself, Dean, who is an SMCP, Smith Manoeuvre certified professional. So that's what I'm doing, and very much enjoying getting out to Canadians and training these professionals to help them.
Right. And that's what I found when I've been a mortgage broker for 15 years now, and the Smith Maneuver conversation with other professionals is not very well understood. And that's what I found. And then I once I read the book and understood it much better, I recognized that I could really use it to help my clients, and they're looking for that kind of relief in today's environment.
Exactly.
Why do Canadians need the Smith Maneuver?
Well, a big one, perhaps the biggest one, is taxation. Every Canadian who's of working age is going to realize that they're going to understand that they have so much of their income going to tax, and typically it's around for the average Canadian about half of their income, close to half. And
Yeah.
we Canadian taxpayers are, consistently within the top 5 highest tax-paying citizenry on the planet.
Right.
We pay more in tax than we do on food, clothing, and shelter combined. Right? So we pay an outstanding amount of tax, and the Smith Manoeuvre helps with that. We've also experienced recently relatively high inflation. It's coming down now, but why the Smith Manoeuvre helps with inflation is because if you're making your mortgage payment each and every month and you're just paying that mortgage down, what you're doing is you're reducing the liability of that mortgage, but you're increasing the equity in your home, the amount of the home that you actually own. And the challenge with that is if you're not putting it to work, it's earning you 0%,
You
less
already
than 0% due to inflation. So you're losing value if you're not putting it to work. So we've got high taxation, we've got inflation working against us. And not only do we have increasing expenses because things are getting more expensive, but we have an increasing number of expenses as we go through life. We're single, we're married, now we have kids, now we get a dog, right? So life just keeps on getting more expensive, and the cost of housing is a very important one. While taxation might take around half of our income, the cost of housing takes another 35%.
Right.
So because of the expense of life and the expense of our mortgage and taxation, the vast majority of Canadians are finding it very difficult to save for their family's future. We've got 2 relatively important goals financially in life. One is to get rid of this big, ugly mortgage because it's killing us. And the other is we want to start to save for our retirement. But because of limited resources, we have to make a decision. Which one do we attack? We can't do both. We don't have enough money on a monthly basis to do both. So do I invest in my future or do I, attack my mortgage? Well, if I don't invest for my future, nobody cares. If I don't make my mortgage payment, somebody certainly does care. Right? So that's what we do. We focus on getting rid of this mortgage at the expense of not investing for our future. And that leads to some seriously nasty places potentially, right? Reverse mortgage, having to work in retirement, being financially reliant on our children. There's a lot of scenarios that people are actually seeing come to fruition that aren't terribly pleasant. And that's because they allowed the equity in their home to accrue as they were paying down that mortgage, and they hadn't been able to save for their retirement. So they're in trouble.
Conditions that we both see too often, and that's what this strategy addresses, is that there is something you can do, but you need to implement it. You need to be ahead of that. You don't want to wait until you're in your 50s, and you can do it then, but it would be nice to have that time back. So the sooner you can implement it, the better off your retirement strategy will become. Yeah.
Absolutely. I was an advisor for a dozen years, and we had a lot of younger Canadian homeowners implementing the strategy, but we had a lot of people in their 50s, 60s, and even 70s implementing the strategy, because if you've got mortgage debt, you've got bad debt.
Right.
You need to do something. And we put mom and dad into the strategy, and then they call their kids, hey, you got to meet with this Robinson Smith guy and learn about this. And we put the kids in the strategy.
Right.
So it really is for people of all ages who have non-deductible mortgage debt, who are having difficulties, seeing when they're ever going to be able to retire. But the sooner you can start, the better, of course.
Right. How much is the strategy worth for the average Canadian homeowner?
The plain Jane Smith Maneuver, which is what I talked about, just using that mortgage payment that you're making already and reaccessing the amount of principal reduction to invest. That's the most basic scenario of the strategy. We're seeing regularly between $300,000 to $400,000 net worth improvement over a typical 25-year amortization,
right,
and several years off the amount of time that they're going to have that expensive debt. But when I was an advisor, I had well over 500 families as clients, and I think maybe 10 of them did not have the ability to apply any of the accelerators. So the vast majority of Canadians implementing the strategy will be able to implement either 1, 2, or more of the accelerators. And with the use of accelerators, we're regularly seeing net worth improvements of up to or over $1 million over a typical amortization period. And instead of 25 years, having mortgage debt well under 10 years.
Right. And that's what I'm seeing. That's what I'm helping clients with. And we're doing the calculations, and we're seeing that we can get it down to that 10 year and under time frame. If you implement the plan and execute it, you will benefit financially, and you'll be happy you did it. Can you please talk a bit about the accelerators?
Yeah, there's a number of them. We'll just list them off: debt swap, cash flow diversion, cash flow dam, the drip accelerator, prime the pump. And just to touch on one of them, the debt swap, for example, a lot of people, they'll have a mortgage. They'll also have some sort of investment portfolio that they built up over the years. Maybe it's not large, but maybe they do have something in an investment portfolio, good for them, that they can apply as an accelerator. And what that entails is, say you've got $15,000 in mutual funds that you built up over the years. Well, you have the ability to liquidate that portfolio for cash. Obviously, you're going to want to look at taxation here, but if you redeem those mutual funds for $15,000 in cash, you can make a prepayment against your mortgage And as we know, if you pay it down, it's made available to you again. So you pull it back out and you can buy the exact same investment you sold 7, 10 days earlier, or a different one. So you're still invested by that $15,000. You still have the same amount of debt that you did a week ago before you implemented this accelerator, but you've got $15,000 less of expensive debt and $15,000 more of tax deductible debt. So that does great things to your tax bill. That does great things to speeding up how fast you're able to get rid of that bad debt.
Right. And can you use the Smith maneuver on investment properties?
This is a very, very popular question. And the answer is kind of yes and no. No, because when you've got your down payment together when you bought your rental property, and then you went and got a mortgage to buy that rental property. Because you borrowed with a reasonable expectation generating income, rental receipts, you're already deducting, hopefully, the mortgage interest on that rental property. And we have to remember that the Smith maneuver is a debt conversion strategy. Going from non-deductible debt, we're going to convert it to tax deductible debt. On your rental property, the mortgage is already tax deductible. There's no need for the Smith maneuver there. There's no debt to convert. It's already good debt. But investment properties can really, really help you speed up the accrual of the benefits of the Smith maneuver that we talked about if you use them appropriately. Just for example, prime the pump accelerator, which I mentioned earlier. A lot of people, they'll have the wrong type of mortgage. They want to implement the strategy. They talk to you, Dean, who's a mortgage broker. You get them into the right type of financing. And a lot of times they'll have immediately available equity, 25,000, 50,000, 100. We've seen $300,000, $400,000, $500,000 of immediately available equity once you finance. Now you can take some of that, or all of it, but you can take some of that and maybe buy your first rental property. Use that as a down payment, mortgage, buy your rental property. What you're doing is, yes, you are in this case accruing more debt because you've already had a $300,000 mortgage. You refinance through Dean. Now you have the ability to pull out another $100,000. There's $400,000 of debt at that point. So this is additional debt if you implement the prime and pump, but it's good debt. And you're using it to buy an asset which is increasing in value over time and also sending you cash flow. And that leads us to another accelerator, the cash flow down. Once you have that rental property, what most Canadians do is if they get a rental property, they set this bank account up and the rental receipts go in each month and then they service the expenses from that bank account. So $3,000 in rent comes in, give or take $3,000 goes out, make the mortgage payment, there's property taxes, there's all these expenses on that business they have. But what you can do if it's set up as a proprietorship, which many are, is you take that $3,000 in rental receipts and the first thing you do with it is you make a payment against your own mortgage, against the house in which you live. Right. And as we know, if you pay down that by $3,000, that HELOC is going to open up by $3,000. You pull it out and then you service the expenses on that rental property. So you're still getting $3,000 in. $3,000 is still going out for the expenses, but first you're overpaying your own mortgage. So you're generating tax deductions at a fantastic rate, right? And you're really, really speeding up the elimination of that mortgage. This is where we see 25-year mortgage gone in 7-8 years or less.
Right. Right. And is the Smith maneuver legal? Do you have any CRA problems with it?
That's another popular question. Yes, it's legal. If it weren't, there wouldn't be 2 books on the subject. There's my dad's, there's mine. That came out in 2019. We even got it translated in French. Right. So, since the mid 80s, every year there are Canadians implementing the strategies continuously for around 40 years.
Right.
I've actually signed up employees of the CRA to implement the strategy. Police officers, judges, right? My dad used to love to tell the story about how many years ago he was just sitting in his office and the receptionist says, Fraser, there's 2 gentlemen in suits here who have paid an unannounced visit. They want to talk to you. And there were 2 guys from the CRA. So they went in and said, Mr. Smith, we want to talk to you about the Smith maneuver thing you've got going on here. Great, Dad said. He loved explaining it to anyone who would listen. So he put pen to paper and explained it. It was graphs and diagrams and all this. And Dad used to say, and about halfway through, one of the guys from the CRA leans forward and says, would this work for a $70,000 mortgage? So yeah, they left and then he never heard from them again, which is as big an endorsement you're going to get from the CRA. So yes, it's legal. The important thing is that you do it appropriately and correctly. And this is why the Smith Manoeuvre certified professionals are very, very valuable. Mortgage brokers like yourself, we've got SMCP investment advisors, accountants, insurance. So making sure that the flow of funds you're setting up right, you're operating it right, you're diligent is very important. If the CRA ever does come saying, hey, what's going on with all these tax deductions that you now have that you didn't have before, you've got a clear trail thanks to the assistance of your SMCPs, a flow of funds. You send them a note and they go away.
Mm-hmm. Right. Yep. So since writing your book, what keeps you busy these days?
My goal, like my father's, was to make sure every Canadian homeowner has the opportunity to say yes to the question, do you want to make your mortgage tax deductible?
Right.
As we talked about, it's not easy out there. It's not getting any easier out there. And I strongly believe that a financially healthy Canadian is a financially healthy Canada.
Right.
So I've got the ability to educate a certain segment, a relatively large segment of the Canadian population. So that's what I love doing. A lot of speaking engagements, presentations, that sort of thing, a lot of interviews. And I'm also spending quite a bit of time building up the Smith Manoeuvre Certified Professional Network. So again, training up professionals such as mortgage brokers like yourself, investment advisors, etc., so that they truly understand the strategy. They are members of a network. So the mortgage broker and the investment advisor and the tax preparer, they all know each other. They can talk about a client's situation
We do.
and
Right.
really service them well. So that's what I'm doing. A lot of education, a lot of training.
Great. So, what should Canadians who are interested in the strategy do next?
Contact you, Dean.
Right?
You're the
I hope
SMCP
you
on
would
this
say
one.
that. That's right. It kind of starts with the financing abilities, right? You
Yeah.
can't implement the maneuver from your bad debt to good debt without a structure in place that allows you to do that on a digital basis. You're converting that payment month by month and using your strategy that you control over to the good debt environment,
Yeah.
and then you can watch your finances change, right?
Yeah,
So
so that's really what someone should do is contact you, Dean. You've got the ability to direct them to the website where we've got a number of resources. So
Mhm.
you're the first stop for anyone who sees this.
Right. Good. Good. Well, listen, it's been a pleasure speaking with you today. Thanks for sharing all that information. I'll be happy to share it with people in my orbit. And thank you very much.
You're very welcome, Dean. It was a pleasure. Be sure to get your copy of the national bestseller, The Smith Maneuver, Master Your Mortgage for Financial Freedom and Make Your Mortgage Tax Deductible.